Good afternoon. This is Sean Golding with Golding & Golding, here to discuss a little bit about when missing an FBAR or filing it incorrectly or omitting certain accounts can be considered criminal. Now, the preface of this is most of the time, if not almost always, an FBAR violation is not going to be criminal. It's going to be civil, and most of the time it's going to be non-willful. Okay? So there are some times, of course, when a violation can become criminal. The IRS has increased enforcement of foreign account compliance in general. More often than not, it's going to be a civil violation, but again, it may become criminal. Some common examples, the three most common examples or ways that a person can be subject to a criminal investigation for FBAR is if they missed the filing, they omitted certain accounts, and they underreported, and they were willful, and that willfulness is to a level that could be considered to be criminal. So let's first go through three common willful examples, and then let's go through three common non-willful examples so you can kind of see the difference. Okay, so let's start with the willfulness, right? The failure to file, okay? Joe, taxpayer, is a U.S. citizen who has many accounts overseas worth several $1 million. He knows he's supposed to file the form every year. He's quite aware of the FBAR and the reporting requirements, but he does not want to report this information to the U.S. government. He has no reason for not wanting to do it other than he doesn't want to do it, which is a legitimate reason, but it's not going to pass muster with the IRS, right? So if you know you have to file the FBAR and you knowingly do not file the FBAR, that's going to be a willful violation. The next common is reporting incorrect values. Again, these are willful and these are intentional. Reporting incorrect values. So Joe, taxpayer, has 4 accounts overseas. He sold his foreign home, and so an account that typically has a lower balance now has $2 million in it. He knows that he's going to be taking the money out of that account and transferring it, so he doesn't want to report it, but he knows about the FBAR, he knows the reporting requirements, he knows the value of the account, and he knows the IRS requires the maximum value. He decides he's not going to report the maximum value. Instead, he's going to report a much lower value that the account out was for most of the year. This is an intentional reduction of the value to artificially reduce the reporting. This is also an example of willfulness. And third is omitting accounts. Joe, taxpayer, has 6 accounts overseas. Most of them are small. He received an inheritance, so one of them has about $4 million in it. He's thinking about giving up his green card and expatriating. He's thinking about never stepping foot in the United States again. So he doesn't think his foreign bank is going to report him because he's been at that bank forever. So he takes the chance and he files the FBAR, but he knowingly does not include accounts that he knows is required to be on the account. So he knows. This is also an example of willfulness. Why? Because he knows he has to file the form. He knows the accounts are required. He knows the value is required to be reported. And instead of reporting it accurately, he intentionally omits the account with the highest balance. Let's move on to the non-willful examples. Okay, these are way more common. In these examples, taxpayers are presumably going to be non-willful. Okay, failure to file FBAR. Jane recently moved to the United States on an H-1B visa. She's been here for all of 2 years. She had some accounts in the foreign country. She hasn't accessed them. She hasn't used them. And the first CPA she worked with never told her she was required to report it. She goes to a new tax professional. He explains to her that she has a requirement to file the account. She goes, oh, geez, and she wants to go and she wants to file and get into compliance. This is probably going to be non-willful. Reporting incorrect values. Jane, taxpayer, has some accounts in a foreign country where she's a permanent resident, so she has several family members. They've been putting gifts and whatnot into her account without telling her throughout the year. So she thinks she's reporting the accurate values. When she's reporting, it turns out she's significantly underreporting, but at no fault of her own. There's the potential like, hey, she should be required to check the balances on her account. But if she had $50,000 in the account and she hasn't put any money in and she hasn't taken any money out and it's a non-interest bearing account, it's probably reasonable to assume that there's still $50,000 in the account. This is probably going to be a non-willful example too. And 3 is omitting accounts. Jane, taxpayer, previously lived in India, and so she has a bunch of accounts, a bunch of dormant accounts She files the FBAR. The dormant accounts have very low balance. She doesn't use them. She files the FBAR each year. She reports the values that she knows. She thinks she's reporting all of the accounts. It turns out that she's not reporting some of these dormant accounts. This is probably not a big deal. It's not the same as intentionally omitting $1 million account. So for taxpayers who are out of compliance, they want to get into compliance before they file the current year if they can, because they want to avoid acquired disclosure. If they did file already, they want to try to fix it as soon as possible, right? If they're willful, the voluntary disclosure program is the option available. If they're non-willful, there's lots of options available. The streamlined procedures, delinquency procedures, and reasonable cause. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.